$690 billion. That is what remains of China's holdings of U.S. Treasury securities, nearly half of the peak level of $1.3 trillion a decade ago. Many people would argue this is nothing more than routine portfolio rebalancing. But when you look at the pace of change and the broader context, the real question is no longer what is China selling, but rather what is the global financial system bracing for? From my perspective, this is not a coincidence. It is a signal of a broader structural adjustment to the dominance of the US dollar. History shows that whenever a reserve currency begins to weaken, it tends to follow a familiar four-stage pattern that has appeared before. What once existed only in textbooks is now unfolding in real time in 2025. To understand where we are today, we need to decode where we stand in that cycle. When you understand how the system operates, what is happening becomes far less surprising because the same familiar signals are beginning to reappear. On April 8th, 2025, the VIX index, Wall Street's gauge of market anxiety, surged to 52. Historically, markets reach this level only when facing risks that go beyond normal volatility. We saw similar readings in 2008 during the global financial crisis and in 2020 amid the COVID-19 pandemic, moments when markets were forced to reassess their assumptions about risk and liquidity. Markets rarely display this level of tension in response to problems that can be resolved simply by cutting interest rates or rolling out stimulus packages. Against this backdrop, the United States is currently running a fiscal deficit of about 6.3% of GDP, equivalent to nearly $2 trillion per year. At the same time, foreign countries collectively hold around $8.5 trillion in U.S. Treasury securities as of December 2024, a figure that deserves close attention. China has established currency swap agreements with 42 different central banks, creating a network with an estimated scale of 3.8 trillion yuan. Put simply, this allows countries to conduct trade without relying on the US dollar as an intermediary. These arrangements do not replace the dollar-based system. However, they do allow participating countries to access liquidity without being fully dependent on the dollar under certain conditions. As these mechanisms expand alongside adjustments in foreign exchange reserves, the nature of the question begins to change. The issue is no longer framed around extreme claims about the end of a monetary order, but around how quickly and to what extent global dependence is being diversified. This is a critical dimension of the global financial system that is often overlooked in short-term market analysis. In economic history, the decline of a reserve currency does not happen randomly. It tends to unfold through recurring patterns that economists and financial historians have documented across different eras. One of the most widely used analytical frameworks describes this process as unfolding in four main stages. Let's begin with the first stage, the build-up phase. This is the point at which the country issuing the global reserve currency begins to accumulate large external financial obligations, so large that fully servicing them through real economic resources becomes increasingly difficult. This phase does not trigger an immediate crisis, but it lays the groundwork for the pressures that emerge in later stages. The second stage is debasement. Here, the reserve currency issuer begins expanding the money supply to meet growing financial obligations that traditional revenue sources can no longer cover. During this phase, monetary policy typically becomes more accommodative. Interest rates are pushed lower, liquidity is injected into the system, and the currency gradually comes under pressure to lose value over time. The third stage is a crisis of confidence. This is when foreign investors begin to recognize long-term risks and act on them. At first, the response is cautious and measured. In some cases, it later accelerates into broader and faster sell-offs. The fourth stage is decline. the central role of the old reserve currency gradually weakens, while alternative monetary mechanisms begin to take on a larger role within the global system. In many cases, this is not an abrupt collapse, but a prolonged transition in which the old system and emerging structures coexist for a period of time. This four-stage pattern has appeared multiple times in modern history, in different forms. Britain after World War II, the United States during the Nixon era, and, in a more extreme case, Germany in the 1920s are three clear examples of this process. These cases differed in speed and outcome, but they shared remarkably similar structural characteristics. One point is especially important to emphasize. China is not necessarily seeking to dethrone or topple the dollar. It is simply hedging its risks. What current developments suggest is that China, like many other countries, is reassessing risk as signs associated with Stage 3, a confidence strain, begin to emerge. What is noteworthy is that in all three historical cases, once Stage 3 began, the reserve currency involved was never able to fully reverse course. Not once. Now, I want to walk you through those three historical examples, each following the same four-stage pattern. As we examine them, you'll see how many of the dynamics we observe today have already played out before, and how those episodes ultimately unfolded. First, let's look at Britain after World War II. Militarily and politically, Britain emerged as one of the victors, but financially, Britain emerged from the war financially depleted. By the end of 1945, Britain was carrying approximately £37 billion in external debt, while its gold and dollar reserves stood at only about £620 million. This created a ratio of roughly 6-to-1, meaning that Britain's financial obligations far exceeded its actual reserve capacity. At this point, Stage 1, the build-up phase, can be considered complete. After the war, countries and territories within the Commonwealth continued to hold sterling in their reserves, believing it retained stability comparable to gold. In reality, Britain's underlying financial capacity was no longer sufficient to support that confidence. Unable to meet its obligations with existing resources, the British government turned to borrowing from the United States and expanding the money supply to sustain economic activity and public spending. In December 1945, Britain signed a major financial agreement with the United States. One of its key provisions required Britain to restore sterling convertibility by July 1947, allowing pounds to be exchanged for US dollars or gold. Once this mechanism took effect, pressure emerged almost immediately. In less than a month, the Bank of England lost roughly $1 billion in reserves. Between August 10th and August 15th alone, recorded losses reached approximately $175 million. At this point, Stage 3 began, as holders of sterling, both domestic and foreign, started converting their holdings into assets perceived as safer. The U.S. loan was rapidly exhausted, forcing Britain to draw down its own gold reserves to defend the system. From then on, sterling operated within a tightly controlled framework, relying on administrative measures and political pressure to maintain stability. Over the following decades, sterling's share of global reserves declined sharply, about 81% in 1945, 58% in 1950, 35% in 1960, and just 11% by 1970. During this period, Britain was forced to devalue the pound twice, first in 1949 and again in 1967, when the exchange rate was adjusted from $2.80 to $2.40. Ultimately, Britain turned to the International Monetary Fund, receiving a rescue package of £2.3 billion to stabilize its finances. Sterling later reached a historic low of around $1.59. By this stage, the pound no longer functioned as a global reserve currency. The US dollar gradually assumed the central role, and by 1970, roughly 85% of global foreign exchange reserves were held in US dollars. Here, the four stages, build-up, monetary expansion, confidence crisis, and decline, are clearly visible. The second example is August 1971, an event commonly referred to as the Nixon shock, which laid the foundation for the monetary system still in use today. By the late 1960s, the United States was beginning to face challenges similar to those Britain encountered in 1945. Under the Bretton Woods system, countries could settle international payments in US dollars, which were convertible into gold at a fixed price of $35 per ounce. However, throughout the 1960s, the United States spent far beyond its underlying fiscal capacity, financing the Cold War, the Vietnam War, and the Great Society programs largely through monetary expansion. By the end of the decade, the volume of dollars circulating globally exceeded the amount of gold the U.S. could realistically use to back them at the fixed price. At this point, dollar-denominated external obligations had surpassed gold reserves, marking the completion of Stage 1. Stage 2 followed as political constraints made it difficult for the U.S. government to cut spending sharply or raise taxes sufficiently. The Federal Reserve continued expanding the money supply, inflation began to rise, and foreign central banks recognized the growing risk. Acting within the Bretton Woods framework, they started converting dollars into gold, leading to a steady outflow of U.S. gold reserves, including from Fort Knox. On August 11, 1971, Britain, one of the key architects of Bretton Woods, requested the conversion of $3 billion into gold to be transferred from Fort Knox to the Federal Reserve Bank of New York. The precise significance of this request remains debated among historians, but it is often cited as an important signal. 2 days later, on August 13th, President Richard Nixon convened a closed-door meeting with senior advisors at Camp David, including figures such as Arthur Burns, John Connally, and Paul Volcker, along with roughly a dozen others. By August 15, 1971, U.S. gold reserves were estimated at around 10,000 metric tons, less than half of their earlier peak, while unemployment stood at approximately 6.1% and inflation at about 5.84%. That evening, Nixon appeared on television and announced the suspension of dollar-gold convertibility, a measure described as temporary, marking Stage 3. This decision effectively ended the Bretton Woods system. Stage 4 unfolded gradually, culminating in 1973 when floating exchange rates formally replaced the old framework. The US dollar retained its reserve currency role largely because no viable alternative was ready at the time. The long-term cost, however, is evident. Under Bretton Woods, gold was fixed at $35 per ounce. While today it trades above $3,000, often interpreted as roughly a 98% decline in the dollar's value relative to gold over more than 5 decades. This comparison reflects gold pricing, not a comprehensive measure of purchasing power across all goods and services. This case illustrates that the old system did not collapse overnight, but was replaced once its underlying conditions became unsustainable. Dollar dominance persisted in a new form, a fully fiat currency no longer tied to gold, supported by the economic, financial, and geopolitical strength of the United States, with its long-term sustainability remaining a subject of ongoing debate. Once again, the same four-stage process is clearly visible. The third example takes us to Germany in the 1920s, a period often cited as one of the most severe cases of hyperinflation in modern history, when financial imbalances unfolded at extreme speed. Most people interested in economics are familiar with this episode, but today we revisit it from a different perspective, not merely to recount events, but to reflect on the underlying structure. By 1918, Germany's national debt had reached approximately 156 billion marks, and soon after, the country was burdened with additional war reparations under the Treaty of Versailles, totaling 50 billion marks, according to the London Schedule of Payments, in May 1921. Annual payments alone accounted for roughly 25% of Germany's GDP, making the financial equation nearly unworkable from the outset. Unable to raise taxes or cut spending sufficiently to meet these obligations, the German government turned to money printing. Before World War I, the exchange rate stood at about 4 marks to $1, but by 1920, the value of the mark had declined by roughly 16-fold, later stabilizing briefly at around 69 marks per dollar. This stability did not last. By July 1922, prices were recorded as having risen by approximately 700% as the government attempted to reduce the real burden of debt through inflation, a strategy that markets quickly recognized. By January 1923, the situation deteriorated further when France and Belgium moved into the Ruhr, Germany's industrial heartland, after Germany missed its 34th reparation payment within 36 months. In response, the German government subsidized striking workers and continued injecting money into the economy, dramatically increasing pressure on the currency. The exchange rate fell from around 320 marks per dollar in mid-1922 to 7,400 marks per dollar by December, before the collapse accelerated beyond precedent. 48,000 marks per dollar in January 1923, 192,000 in June, 170 billion in October, and by November 1923, approximately 4 trillion marks for $1. During this period, prices changed by the hour. A loaf of bread might cost 20,000 marks in the morning and 5 million marks by evening. Restaurants adjusted prices while customers were still eating, and workers were paid twice a day because wages lost value between lunchtime and the end of the workday. Faced with this breakdown, Germany introduced a new currency, the Rentenmark, in October 1923, at a conversion rate of roughly 1 Rentenmark to 1 billion old marks, rendering the old currency nearly worthless. Historical accounts often note that banknotes were used as fuel for heating because they were cheaper than firewood, a symbolic image reflecting the scale of the collapse. Germany's case shows how the same sequence of financial imbalance can unfold within 3 years rather than over several decades, as in other countries. Yet the stages remain identical: build-up, monetary expansion, crisis of confidence, and collapse. 3 different countries, 3 different historical contexts, yet when viewed systematically, striking structural similarities emerge in how currencies occupying central roles gradually lose balance over time. This is not an abstract theory, but a pattern repeatedly documented in economic history, even though the speed and severity vary from case to case. When this framework is applied to the United States in 2025, several notable elements begin to appear. As of December 2024, foreign countries collectively held about $8.5 trillion in U.S. Treasury securities, while total U.S. public debt exceeded $33 trillion, and the federal government continued to run annual deficits of around $2 trillion. The scale of these obligations makes full repayment through taxation or economic growth increasingly difficult, pushing the system toward continuous debt rollover or monetary expansion, a structural challenge that has appeared in different historical settings before. Over recent decades, the Federal Reserve has expanded the money supply to finance deficits, stabilize markets during crises, and support asset prices through publicly stated policy tools such as quantitative easing, forward guidance, and yield curve control. This is not a conspiracy theory, but a feature of modern monetary policy. At the same time, the behavior of major creditors has begun to change. China reduced its U.S. Treasury holdings by approximately $173 billion in 2022, a further $50 billion in 2023, and $57 billion in 2024, bringing total holdings down to around $759 billion by the end of 2024, and continuing to decline toward roughly $690 billion by October 2025. These moves have coincided with China signing currency swap agreements with 42 countries, with a nominal scale approaching 4 trillion yuan and expanding the cross-border interbank payment system, CIPS, which now includes 168 direct participants and more than 3,400 indirect participants. Together, these developments suggest not merely isolated portfolio adjustments, but preparation at the level of financial infrastructure. Since early 2022, Chinese banks have also reduced dollar-denominated lending to emerging markets, a trend reported to have intensified following financial sanctions related to Russia in 2022, aligning with Beijing's long-stated objective of reducing reliance on the US dollar through observable actions such as reserve diversification, gold accumulation, and expanded bilateral settlement mechanisms. These developments do not imply an immediate collapse, but they do indicate shifting confidence and behavior among major holders, a factor that played a critical role in previous monetary transitions. History suggests that once such repositioning begins, reserve currency issuers often respond with familiar tools: interest rate adjustments, emergency credit lines, bilateral agreements, or capital flow management. These measures can extend the adjustment period, but they do not necessarily resolve underlying imbalances. History also shows that monetary transitions do not occur overnight. In Britain's case, the process unfolded over decades. In Germany's case, it happened within a few years. The difference comes down to a single variable: confidence. What we are observing in the United States today, from public debt exceeding $33 trillion to the gradual withdrawal of major creditors such as China, is not a prediction of imminent collapse. It is a reminder that the global system is adapting to long-standing imbalances. The financial order is evolving, and the most important question is not when will the dollar collapse, but rather, how prepared are you for a multipolar world, one in which dependence is no longer concentrated in a single system? Thank you for following today's journey through financial and economic history. Feel free to share your thoughts in the comments below. Goodbye, and see you next time.